You don't want to set up a scenario where it looks like they're paying for your past mistakes. So you want to try to keep it as clean as you can. How do I make money? Well, there's 5 types of fees. The first one is management fees. So the first type of fee you can charge in a fund model is a management fee. Now, you guys may have heard of management fees in the context if any of you own mutual funds. They charge a management fee. It's a management expense ratio, MER. So they have a way of calculating it. Management expense ratios are anywhere between 1 and 2.5%. It really depends on the asset you're running, how you're running it, the size of your portfolio, and what your investors are willing to accept as a fair management fee. But I can tell you right now, between 1 and 2% is fair. And the question is, what is the management fee typically charged on? So management fee is, again, it depends on the context of the asset. If you're buying real estate, typically you'll call it an asset management fee, not just a management fee. And like I said, 1 to 2% is market. Now the question is, what is that fee on? Do you charge it on the amount of capital that you've raised, or do you charge it on the total value of the asset? That really depends on you. It depends on how those numbers add up and ultimately how much work is involved. So you got to make sure that there's kind of a fair balance there, and we get into a fair bit of that. So for example, if you did a deal where you have 95% financing CMHC and you do a new build and you're only raising 5%, charging a management fee on the 5% is very low. You guys understand? No matter how high the fee is, it's low because you're only raising 5%. Like if you did a $20 million deal and you have to raise $1 million, well, if you're charging a fee on the $1 million, it's tough because it's a small fee relative to the size and scope of the asset. So there's a balance. There is no hard and fast rule. Whereas if you're buying an asset all cash, there's a different type of approach there. So the management fee is important. The management fee is also typically charged on a recurring basis. So it's not a one-time fee, it's a recurring annual fee. In your legal documents, you would specify if it's paid monthly, quarterly, annually, and more importantly, where is it paid from? All these fees within your legal documents that your securities lawyer would help you with would have to decide where those funds are coming from to satisfy the payment. So in other words, are you raising additional funds to pay yourself fees? If you are, there's nothing wrong with that. You just have to disclose it. It's a function of disclosure. Everything is a function of disclosure. Or are you getting paid your fees from the operating revenues of the business? If you are, how does that work? So on and so forth. So that's the first type of fee. The second fee is a performance fee. So performance fees can be a variety of different fees in the context of real estate. One type of performance fee could be an acquisitions fee. So in other words, you have a fund. Your fund is acquiring, let's say, apartment buildings in Texas, and you're buying buildings between X and Y size. You haven't bought a building yet, therefore you haven't technically performed. 2 months later, you bought the building, you closed on it, your building was worth X, therefore you could charge a fee for the performance of executing said agreement. So as an example with Ashwood Park, if we bought the building, remember yesterday I told you guys that I actually shot myself in the foot when I continued to negotiate the price down? That's because the performance fee is based on the asset price. Whatever amount of money, it went down by about 30 or 40 grand because I knocked 700,000 off the price. But that was the best thing to do for everybody, so I did it because that's what you do for your investor. There's other types of performance fees in a business. If you're doing an operating business, you might have performance fees built on hurdles, built on milestones that you hit based on successful executions of certain parts of the business, maybe securing certain contracts with certain distributors, vendors, whatever it is. Performance means that you've executed said thing, essentially is what that is. It's a very loose term. The third one is entry and exit fees. So in other words, in the context of real estate, a performance fee is interchangeable between an acquisition fee and an entry fee. Essentially, it's an acquisition fee. You can also charge a disposition fee. So when you sell the asset, you can charge a fee. Why would you charge a fee? Even though you may have a commercial broker involved, you're still directing traffic. Even if you're using a broker, it's still a lot of work. So you charge a disposition fee. And even with a broker, you're still pushing the ball uphill, right? So disposition fees are something you can charge. Again, the market is between 1 and 2%. 1 and 2, 1 and 3%. That is the market. Nothing wrong with charging it, just disclose it. My formula, guys, just so you know, when I go through all these fees, and on the calls you may have heard me say this, ultimately you want to make sure that your total fee structure isn't more than 20 or 25% of the total compensation you're going to make. So in other words, your investor, if they were to do the back of the napkin, if they see that you're making more money off just doing the deal than actually making everybody money, that's a shit deal for the investor. It might be a good deal for you, but your investor will not be happy. You know, your reputation, sure, but financially, there's no incentive, there's no alignment. And really intelligent investors will see that. Another fee, I guess you could fit this into the performance fee, would be the equity split on the profit that you allocate. So for example, my deal with Ashwood Park, I did a 70-30 split with my investors. There's a few other fees that, not fees, but like hurdles we built in for our investors to make money. But ultimately, there's a 70-30 split on the equity. So whoever puts in the money, my money gets treated the same way as my investors. So when I put my money in, investors put their money in, but we did a 70-30 split. 70% goes to the investors, 30% goes to us. And that only happens after the investor gets their money back. So we don't participate in any of the profit from the sale, obviously, or the refinance, for that matter, until they get their full capital back. Because I see deals sometimes where they'll have clauses in the agreement where they can refinance and pay themselves a whole bunch of profits, but the investor's still at risk in the transaction. Their equity is still tied up. Meanwhile, the management team scooped up millions of dollars in profit. I don't do that. I wouldn't do that. I don't think that's right. But again, that's one of the things to pay attention to in your legal agreements. You know, again, you want to make sure you're aligned with your investors. Really smart investors are going to see through this stuff. There's only about 5 or 8 things they're looking for in the agreement relative to the performance fees and how they're paid. And the smartest investors will cut you in half immediately. They'll know. Administrative fees. So in the context of running a fund, you probably, all likelihood, will have to charge administrative fees to cover, as the name suggests, the administration of the fund. Because ultimately, you're going to have some accounting fees, not accounting fees, you're going to have just technical administrative fees. Like you're going to have somebody who's filing certificates, that same person may have to deal with the securities lawyer, may have to do the filings, may have to deal with the auditors on the reports, whatever it is. There's some administrative fees that do need to get charged in that regard. You build that into your model, which again we have within the context there. And then the final one is called, I just called it specialized fees. And just one sec. And the reason why I call it specialized fees is because it really does depend on what your business model is. Case in point, if, for example, Pavel is doing a development and he is also using his construction company to do fulfillment for his investment company, and he's charging fees like project management fees, construction fees. There's nothing wrong with any of this, but you do need to disclose it. It's an important line item that has to be disclosed. Guys, you can do these deals however you want. You can literally structure a deal and say, I'm raising $1 million and we're only investing 10 cents. You know, I don't recommend it because you're basically telling your investor that they're never going to either get their money back or make any money. But technically speaking, if you disclose everything, it's there. Now, nobody would obviously invest based on those terms, but obviously any fees or anything you're charging, you have to disclose within the documents. Specifically, if those fees are coming from investor proceeds, like specifically. And then not just the proceeds, but funds after that, when the cash flow comes in, you have to be very clear on where that gets distributed. So project management, construction management, those are specialized fees in a real estate context. Let's pretend you own a property management company that does assets, okay? If Kathy had a property management company that she was employing to buy her own properties with investors, and there was a property management fee that went to her, although it's standard practice, you still have to disclose it because it's a disclosure line item. No one's offended that you're getting paid to do what you're supposed to do, but the function is you have to disclose it. That's really what it is. So guys, these are the 5 major types of fees that you can charge. In addition to these fees, when you structure yourself correctly, you can also recoup your expenses that you've spent on your fund and that you've spent on what it's required you to get to this point in the business. Whatever it is that you want to burden as an expense, you just have to disclose it. I don't encourage you to burden the fund with too many expenses, especially early on, because your new investors are going to have a really tough time to fund. You know, you don't want to set up a scenario where it looks like they're paying for your past mistakes. So you want to try to keep it as clean as you can, but any direct expenses, lawyer, legal, financial advisory work, anything that, you know, if you feel like we've been an asset to you and we're part of that journey and you want to recoup that, as long as you disclose everything, it's a line item. It's a disclosure line item. That's all it is. As long as you're transparent and you're disclosing, it's totally fine.